and welcome to ProfitSee's Knowledge Base. My name is Sam, and today we'll be covering the business valuation feature in ProfitSee. This is an excellent tool for you to assist your clients through various stages they may be going through and can also reinforce the value you're providing them. Ultimately, a business is worth what someone is willing to pay for it, and there is no one correct way to value a business, but most agree the discounted cash flow method is best. The discounted cash flow method attempts to place a value on the business today by determining the net present value of expected future cash flows and accounting for time value of money. This is achieved by combining the discounted cash flow, cash on hand, and terminal value of the company. There are several inputs you must decide on when forecasting a business's value using the discounted cash flow method. The first of these is the discount rate. The discount rate refers to the interest rate used in the discounted cash flow method to determine the present value of future cash flows. This can also guide decision making on whether or not a business or investment is financially viable. Most discounted cash flow method models assume a discount rate of 12%, but this may vary from business to business. Next is the growth rate. This is the rate at which you expect future cash flows to increase. This cannot be higher than the discount rate, since that would imply that there is no risk in the business. Unlike the discount rate, there can be a fair amount of tinkering with the growth rate to find what will produce an accurate and reliable forecast. Of course, this is an equation solving a very complex real-world circumstance that should be seen as a guideline for strengthening and building the future value of your company. After this, you will be asked to update the profit and loss projection for the next 5 years. The first part in the walkthrough, you will be asked to project the trend in revenue. You will then forecast variable expenses, which by default will be based on the current margins based on revenue. You may also opt to adjust the variable expense margin based on a percentage trend. Lastly, you can apply a percentage increase or decrease to each of your fixed expense line items across the board or individually. Now click Start Valuation to see a projection of what the business is worth. The company's valuation will be listed in bold with an explanation of the formula used below. The discounted cash flow takes the forecasted cash flows for the next 5 years based on the profit and loss projection you updated to calculate their present value. The small calculator icon will show you the projected net income for the next 5 years and the present values. Cash on hand is simply the amount of liquid cash currently present in the bank. Terminal value attempts to forecast future cash flows beyond 5 years. After updating the profit and loss projections to your liking, you can then generate this report in PDF format to add in notes about the assumptions that have been made. You can email this directly to the client, or you can download it for your next meeting. Thanks for watching. That's a general overview of the business valuation feature in ProfitSee. If you have any questions, please reach out to your account manager or contact us at support@myprofitsee.com.